All right, let's dive right into this explainer. We are unpacking a massive, multi-billion-dollar market earthquake today, the acquisition of digital infrastructure giant DigitalBridge by SoftBank. We're going to look at exactly what happened, why it matters so much to the broader tech market, and the incredibly complex financial maneuvering happening beneath the surface right up to the middle of 2026.
We've got a lot of complex financial data to cover today, so here's our roadmap. 1. The SoftBank buyout. 2. The digital infrastructure boom. 3. Under the financial hood. 4. The bull versus bear case. 5. Refinancing the debt. And finally, 6. What happens next?
Section 1. The SoftBank buyout.
So, what actually happens when a massive tech conglomerate wants your assets? That is the literal multi-billion-dollar question that set the stage for DigitalBridge's 2026 trajectory. You know, for a company that manages the nuts and bolts of our digital world, attracting a global giant like SoftBank, well, it changes the entire narrative of the business overnight. SoftBank answered that question with a definitive all-cash offer to acquire DigitalBridge for exactly $16 per share. Bam. Just like that, this set a hard price anchor for the stock. It completely shifted how the market viewed the company's valuation, going from standard market fluctuations to trading almost entirely around the anticipation of this $16 deal actually closing.
And honestly, the stockholders overwhelmingly agreed. At a special virtual meeting held on April 23, 2026, a staggering 96% of the votes cast approved the merger. With 69% of all outstanding shares participating, that's over 121 million shares, it was a resounding mandate from the shareholders to basically take the cash and approve the buyout.
Section 2. The digital infrastructure boom.
To truly understand why SoftBank paid up, we need to peel a layer back and look at DigitalBridge's actual everyday business. When we say digital infrastructure, we aren't just talking about abstract cloud concepts. We're talking about heavy physical assets like data centers, macro cell towers, massive fiber networks, and edge computing facilities. They aren't just a traditional real estate company. They're building and operating the critical physical backbone that makes the global AI revolution and advanced 5G connectivity even possible.
And guys, this number is just staggering. As of March 31st, 2026, DigitalBridge boasts over $118.9 billion in assets under management. They are operating at an incredible scale, positioned perfectly at the convergence of power grids, artificial intelligence, and network infrastructure. They're actively scaling the exact businesses our modern digital ecosystem relies on every single second of the day.
Section 3. Under the financial hood.
So how do these massive world-spanning assets translate to quarterly performance? Well, the growth engine is clearly firing on all cylinders here. Looking at Q1 2026 earnings, revenues jumped impressively from $45.4 million last year to $72.2 million this year. That is a robust 26.8% year-over-year revenue growth, which significantly outpaces the broader capital markets industry. Demand is translating directly to top-line expansion. Even more importantly, that revenue expansion successfully pushed the company back into profitability for the quarter. They reported $5.3 million in net income, or 3 cents per diluted share. This is a huge positive shift from the losses they posted in Q1 of 2025, proving that strategic adjustments, like their recent acquisition of data center assets in Japan, were definitely paying off.
Section 4. The bull versus bear case.
Now, whenever a company is in the middle of an acquisition, you really have to scrutinize the underlying financial narratives. And right now, there is a fierce debate playing out among analysts. The bull case points to a rapid 45.7% trailing earnings growth and that strong revenue scaling we just talked about. But the bear case raises a massive red flag. Their incredibly high 77.2% net margin is heavily reliant on a $44.7 million one-off gain. Skeptics argue this single non-recurring gain is artificially propping up their profit margins, which might be masking underlying vulnerabilities like rising regulatory costs or market saturation.
Because of those mixed signals, DigitalBridge's valuation is sitting right in the middle of the spectrum. At a 30.4 times trailing PE ratio, they are significantly more expensive than their direct peer average of 11.7 times, but they're still cheaper than the broader capital markets industry average of 42.2 times. It's a classic valuation tension. Investors have to weigh the incredible long-term potential of AI infrastructure against the immediate reality of their current earnings quality. For anyone watching tech, this is exactly how AI hype gets priced into physical assets.
Section 5. Refinancing the debt.
Let's look at a major corporate action they took on May 11, 2026, right in the middle of waiting to be acquired. To translate the dense credit data, DigitalBridge basically secured $400 million in new financing backed by their own investment management fees. They split it nicely between a $300 million fixed-rate note locked in at 6.326% due in June 2031 and a $100 million variable revolving line they can draw on as needed with an anticipated repayment around June 2029. The strategy here is actually fascinating. The net proceeds weren't just used for expansion, they were used to cleanly repay their older Series 2021 securitization notes. Think of this like cleanly refinancing the mortgage on your house while you are already under a firm contract to sell it. It ensures absolute financial stability, retires older debt, and shores up their capital structure using their stable fee-based cash flows, entirely regardless of the pending buyout.
Section 6. What happens next?
All right, let's step back from the balance sheets for a second and look at the road ahead. The timeline of events perfectly summarizes our journey today. It shows the rapid progression from that decisive April 23rd shareholder vote approving the $16 buyout, moving through the proactive May 11 debt restructuring to keep the balance sheet strong, and pointing straight toward the expected deal closure in the second half of 2026. The company is effectively keeping its house in perfect order while waiting for customary closing conditions and final regulatory approvals to clear. Which brings us to a much larger theme we're seeing across the global market. As essential digital infrastructure consolidates into the hands of mega conglomerates like SoftBank, who will ultimately control the physical backbone of the AI revolution? It's a provocative thought, right? What happens when the very foundations of our digital future are bought out? I really hope this explainer helped you grasp the intricate mechanics behind these massive market shifts and why these multi-billion-dollar infrastructure deals matter so much.